Finding Your Mojo, Fireside Chat with Ajay Srivastava, MD of Dimensions Consulting. Ajay, it's always a pleasure to talk to you, but today I want you to talk to a lot of youngsters, a lot of millennials who are, of course, watching us and looking to you for advice. Everyone always talks about how equity is the best way to create long-term wealth and help people retire early, achieve your goals, fulfill your dreams, aspirations. What are your thoughts on that?
Thank you for calling me on the show. And I think it's great talking to the youngsters because I think they're at the point of time in their lives where the kind of opportunities they have is absolutely humongous and incredible. And I'm not talking of opportunity in the capital market. I'm talking of opportunity in the real world. And my first thing to that the way to create your own wealth, and I think that's most important for everybody to understand this, is to focus on your own work. You have seen hundreds and hundreds of millionaires, billionaires coming out of ESOPs. You read about them, you talk about them, but there is one common element in all those people was unified single focus. You never heard Steve Jobs going into looking at the trading screen. Neither do I, by the way. My office doesn't have a television set. It doesn't have it, right? You need to focus upon your work because this is the world which is rewarding people with ESOPs and the liquidation value as never before. We could not see that 25 years back when we started our lives, but today you can see it. So my request to you, suggestion to you is that if you got a good break, whether it's a startup, mature company, wherever you are, your career is your best way to create your wealth, and that's a kind of wealth you can never even imagine that you can create. So equity is notwithstanding, your work, your passion, your whatever you're doing is your way to your wealth, my friend, and retirement early, not equity trading.
Ajay, how does one go looking for those opportunities? I know this is not a career counseling session, but just throw some perspective. What sectors, what companies, what sort of ideas out there is what one should be going after in order to be able to make those ESOPs, right? Because at the end of the day, while yes, you need to work hard, but there are lots of people working hard. There are only a few companies that actually become unicorns and then reward its stakeholders or its employees.
I say always, I give an example that the man who works the hardest is the laborer who digs the roads and in the 50 degrees of heat in India, and he gets rewarded the least. So believe me, I'm not talking of working hard, I'm talking of working smart. And the best way to work smart is that you follow the biggest of the private equity funds, the venture capital funds, where they are investing. If you got an employment in those kind of companies, you are a winning ticket. If you see Sequoia somewhere there, you see Tiger Global somewhere there, you see Goldman Sachs there, just follow the lead. You don't have to do too much R&D. Of course, you miss out some of the early startups which start with the base level, but that's fine. You can miss out, that's not a big deal. But when you look at a Sequoia investing in a company and you get employment in that company, that's the gravy train you want to be on. So you are very clear signals are the equity investors of the marquee equity investors of the world are the ones which are giving a loud and big smoke signal saying, come and work here, we will make money, you will make money. And those companies, private equity funds, venture capital, reward the employee. That's the best part. So don't have to dig too deep. Just follow the lead, read the newspaper headlines, try to get to those companies.
Right. So you obviously bet big on startups versus mature companies, right? At least for employment.
Well, I certainly believe that mature companies will give employment, and they will give employment to people who come out of marquee business schools and become more bureaucratic and traditional, and they will fail. And that's why I don't recommend it. And why they will fail? You see the biggest failure in this country. ITC, marquee name, failed. United Spirits, marquee name, failed. At the end of the day, Citibank, my own bank, I started with Citibank as my career. Okay, you see what's happening? They're going out of they invented consumer banking in this country and they are now leaving this country. And the reason being because they don't hire those people. They used to hire people like us and others which were aspiring equivalent to startups. Today they hire bureaucrats. So if you follow a large company, you will end up being a bureaucrat and never make serious kind of money. If you want to make serious kind of money, go to the new guys with the fire, with the belly, and with being funded correctly by these marquee funds, and you are on the right track.
I want to extend that conversation into investing because, of course, these are kind of companies you want to seek employment with. But if you're not getting employed, if you don't, for whatever reason, are employed with these companies, you can at least ride the run by investing in these companies, right? So what are the big themes? What are the sort of spaces that you like that could become unicorns over the next decade?
You know, okay, I have a different theory on this one for investors, for youngsters, is that, you don't need to invent, you got a limited capital. And that's the best part of the worst part or best part, I do not know. But you got limited capital because you're starting up in your life. Therefore, there is very little room for experimentation for you. Yes, Robinhood, yes, Reddit crowd is all fine, but provided you don't get caught on the wrong side of the trade. So therefore, for you, the best trade and to consolidate your holding is you follow what market is doing. Like for instance, if you followed the lead of cyclical recoveries, whether metal stocks, whether this thing, you would have made tons and tons of money. You don't make tons of money by buying a Nestle. Nestle will edge on, give you the return, but that's a retired people's stock. You don't make big money by Infosys. You make big money by chasing themes at the end of the day, and you got to be alert to the theme. And once you get onto the theme, then you stick on to it for some time. Don't get out of it in 20 days saying Vedanta was 60 rupees, now it's become 90 rupees, I need to get out. Ride the whole trip, ride the whole voyage, and you'll make money. So the deal is, don't look for just marquee name, because they are for a different set of investors, not for you. For you is the theme of the next 12 to 18 months, and you got to ride the theme. I think it's like windsurfing. You catch the surf, you catch the wind, and you're going to sail through. Or you're going to struggle in blessing waters. Sorry?
I said, what themes do you like then?
See, today, very clearly in India, you don't have to be a rocket scientist in today's, when you sit today and say the largest money is going to be made by things like hospitals. They'll make huge amount of money because they're a precious commodity. You see in how scarce they are. And now government has finally given in and said, price where you want the vaccination. And I presume most of the new developments will say that. Right? You've seen steel mills today. There is no greenfield coming in this country for next 5 years. Steel has run up, but it's going to go up much more because there is no nobody coming in this country. And Atmanirbhar Bharat says that imports will be always stifled. So, you ride the theme, and these companies have got the first year cash flow, free cash flow. Can you believe it, Amina, that steel companies had the first year of free cash flow positive in a decade? In a decade. And this free cash flow is now going to last you for the next decade. So even if your prices have gone up and scares you, don't worry about it. You will ride it. Commodity is the same story. You will ride it for next 5 years at this point of time. So do not worry about these stocks. And the gig economy. And why limit yourself to India? We are allowed $250,000 per person to invest overseas under LRS. I would strongly recommend every youngster to open an account and start investing abroad, because some sectors like EV, technology, biotech, you can't buy in India and you need to go abroad. So don't look at India for these sectors. You go abroad, invest in those companies, and that's the way to build your whatever little net worth you've got, split it between Indian domestic story and global gig economy stocks, which are rocketing up.
Right. In fact, it's a really valid point, because a lot of our dreams and aspirations are very international nature. You want to study abroad, you want to vacation abroad, and of course, investing abroad will also help you, achieve those goals with the currency exposure as well. Ajay, also beyond that, we always talk about how you need multiple sources of income, right? And I want to talk to you specifically about what a lot of youngsters now are actively learning in trading. It's an asset class in itself, and I'm talking about currency markets here. What are your thoughts on trading currency markets? Is it as double-edged as equity market trading? And of course, if one is going to, become an expert at currency trading, can he accumulate wealth and move that wealth to his long-term purpose? That, of course, could then work for him to achieve his long-term goals.
See, in terms of priorities and in terms of return on capital employed, I would put currency the lowest in the hierarchy of trading at all. You can make some money sometimes, you can make some money, little money, quite a lot of time, but when you lose very big, and the market turns around against you very fast. And sitting in India, where we have got an interventionist RBI at this point of time, when you start trading rupee versus dollar, you're really not going to be productive in terms of return. So I am sorry, but this currency trading is why for companies at the end of the day who got infrastructure, who got dollar exposures, either inflows and outflows, and they hedge and they can use that actual hedges to make products. But by and large, let me tell you something, most Indian companies have lost money in the currency trading. If you look at all the balance sheets, it is horrible. Some companies, and I'll give you some example, like even very marquee company like Syngene, you will see 2-year balance sheet net profit wiped out because of the FX covers which went wrong. So, if strong marquee companies are not able to find the way to do this correctly, and the returns are paltry because, the currency movement don't happen 10%, they happen 0.2%. So you need to put lots more capital into this to get meager return. I would say stay away from it. Equity is a big basket for you guys. Just focus on it. And as I said, if you focus enough on the US market, that is where the big multiples are coming from, not necessarily the Indian market.
Right, so add diversification by adding international equity is what you suggest. In equity as well, direct equity or mutual funds, I know both are important, but for multiple returns, I think direct equity might be a better sort of route, right?
Well, the answer is yes and no, Meena. And I think the answer is no is that sometimes mutual funds are good because they play a theme. And the problem in India has become that mutual funds are very expensive. The expense ratio is 2.2%. So they eat up 2.2% of your profits in any case. Again, US is far ahead because US has got ETF across all the sectors at this point of time. And their cost of ETF is 0.2% or thereabouts, or 0.4%. In India, if you want to play a theme, sectoral theme, I think mutual funds do a wonderful job, particularly banking. If you want to play, instead of trying to buy one stock and that may not perform, you go buy the banking mutual fund, put whatever your money is, and you'll ride it pretty well, the index of banking. And the same goes for pharma, same goes for IT. I think these three sectors have done remarkably well in capturing an essence of an industry and allowing you to take an exposure. So I would say rather than trying to do multi-caps and large caps and kind of stuff, mutual fund, look for the theme, play the theme. You like pharma for next 6 months, go dump your money in pharma, 6 months later, sell it out. Yeah, you'll have a 1% exit load, but that's okay. Your returns are out and you've taken exposure to sector. So use sectoral mutual funds, Amina, more than general mutual funds, and you'll be better off.
So bet on sector-specific funds as opposed to more macro kind of themes. Ajay, moving away from equity, one asset class I can't not ask you about is Bitcoin. Of course, there's so much of talk about it. People are making lots of money. Of course, Tesla is also a case in point, investing big in Bitcoin. How do you feel about Bitcoin? What is the advice you have for youngsters who are getting drawn in this attention?
Listen, if you are whether you're a youngster, you're not a youngster, if you're not in Bitcoin, you're a social outcast, okay? Because you've not been kept up with the time. So I don't know what returns will come out of it, but I think to be socially acceptable, you got to have Bitcoin in a portfolio, okay? At the end of the day. And come on, you can't be sitting with your colleagues or a girlfriend in the evening and bragging about, I bought this stock. No, you talk about Bitcoin, that's become more exciting pop talk. So, okay, and that's a frivolous note, but on a more serious note, the point is none of us know where this Bitcoin will head at the end of the day. And RBI in India has not made life easy. Income tax has not made life easy. Notices have come to say your investment. RBI keeps threatening and saying, I'll ban it. They've already banned it actually. And then the regulation starts. So, I still believe that there is a life in Bitcoin. But since we are Indian resident and citizens, our regulatory scenario makes it so difficult that tomorrow, being a youngster and you get income tax notice, you're going to spend much more money, or RBI telling you you've done the wrong thing, trying to handle that the money you make. So if you ask me, it's a must-have. But given the regulatory scenario, just be careful what you're doing, because you could be into a regulatory problem faster than you say Jack. And you know how once government gets to you, what happens to you. So
what do you think is advisable in Bitcoin then? While it's a must-have, you can't ignore it. Of course, there are regulatory problems, but if I had to just, in an idealistic world, how much sort of exposure would you advise individuals to have to Bitcoin?
See, today, I would not recommend for individuals to have not more than 10 to 20%. 20 is upper limit. And for the simple reason is two reasons. One, the volatility is, you see the volatility is incredible. It's about 10 to 15% up and down, and that can take your sleep away. And if you like to sleep easy, Bitcoin is not the place for you at the end of the day. That's one, it's the volatility. Number two is we need, being a youngster, which we are addressing the program to, I presume your capital the amount is not so unlimited or not so large. So therefore, given that you have a smaller corpus to work with, you need to address volatility issues more than normal. In America is different. You're getting a subsidy check in the mail and you're sleeping in your dad's garage or in the apartment and you go and invest it. India doesn't have social security net. So if you're out of a job tomorrow, your EMIs will come into play, and that's a time when volatility hits you on the Bitcoin, you won't be able to get out of it easily. So my request suggestion is that it just depends upon your financial status, but certainly don't put more than 20% of your net worth, because 20% going up and down 10% every day is a big volatility factor in your portfolio.
Very lastly, Ajay, the new generation is the DINK generation, right? Where it's dual income, usually no children, or maybe one child, but not, of course, at this point of time. Their risk profiling is, of course, much higher than most other people with a moderate risk profile. For somebody who belongs to the DINK generation, what is the advice you have for them? Do they still have to have a balanced portfolio? Because if they can take risk and there are very few responsibilities and multiple sources of income, then can 100% to equity be advisable, or at least 90-10 versus the 70-30 typical advice that we give people in the 20s and 30s?
See, again, I'd say that it depends upon your job profile. If you're sitting with large-scale stock options in your company, or you're building up a corpus in the school of stock options, then I'm recommending you go 100% equity, because it is dumb not to do it at this point in time. There's always some accumulation. Amina happens because of a provident fund, superannuation, etc. Every company has some accumulation. So there is a fixed, component being built up. But if you're in the age group of 25 to 45, I would seriously recommend, and you are working in a decent company and your stock options are in place, go for equities, because that's where it is going to be. That's one. Number two, it's not about equities. I think, Amina, the question is, what is the kind of equities? Do you go and invest all in small caps? That's the danger of what the youngsters do at the point of time. And a lot of youngsters, well, mature people do it. We saw the kind of losses in small cap in the last 3 to 5 years. It's on the last 3 months, they have recovered back. It's not about equities. It's about the nature of equities that you go into. I think, do you go into the C-class category companies, or do you go into a mix of companies? That's where the distinction is. It's not about 180 and 20. It's about, if you're doing a good job with your equities, balancing it well with the nice stocks, growth stocks, and cyclical stories. At the end of the day, nothing will happen to Tisco. Price may drop to 300 rupees, but it'll come back over 5 years. Right. So if you do that, I don't think you need to worry about allocation principles. But if you're all going to be, it's a gambling table, all or nothing, as they say in poker, all in, then your all in has to be in a very conscious way with the right equity, not with the C-class.
Right. Thanks, Ajay. It's always good talking to you. That was great advice.
All the best.
Thank you.